The title today is Unlocking the Potential of Our Marketplace, because we believe that Malaysia is actually a market of the move and that there is a lot of growth potential. And if you actually look at it and you explore, you investigate, there are opportunities for everyone. So the three core messages that we want to give is that we do have a diverse range of listed companies, and some of them of a good section of them are actually of international standards. They are transparent, they have good corporate governance, and we have some very good sectors, niche sectors that we can boast about, like the oil and gas. Now we have the logistics, like for example, our carrier, Air Asia is the biggest low-cost carrier. KLIA2 is the largest low-cost airport, and that is gaining international attention. So we have, we have the plantation sector. So there are now the construction sector is there. So we have our niche sectors that we can boast about. And in terms of the messages are, we're a diverse marketplace, we're sustainable, and the ASEAN's multinational marketplace. So in terms of sustainable, we really have to thank the government and economic transformation program, which they have actually been the driver. They have moved Malaysia from a very what do you call that? The cronyism and all that. They have made Malaysia a very business-friendly country. Like current, we were actually ranked by the World Bank as 6th best international in the world for ease of doing business. Singapore is the first. So we are after Hong Kong, New Zealand, US, Denmark. So Malaysia is ranked 6th in that. And that actually goes, we have to thank the government, the GDP and the EDP. And I think they have more than 144 billion set aside for investment. So there is going to be growth, sustained growth for the next at least 2 to 3 years. And we are, the ASEAN's multinational marketplace in that sense. We have very good homegrown companies that we never really thought about, that has gone regional, that allows investors who want a regional exposure to actually tap. If you invest in one of these companies, you actually get regional exposure. And some of them are actually gone international. So some of the, like for example, I just want to read to you that the banking sector, and this is also by Bloomberg, that 3 of ASEAN's top 5 investment banks are Malaysian. So there are 5, they have ranked CIMB, DBS, Maybank Kim Eng, RHB, and UOB. And CIMB is the highest ranked Asia-based investment bank in Bloomberg, according to Bloomberg 2013 Asia Pacific ex-Japan League table. Maybank is ranked world's 19th strongest bank according to Bloomberg, 10th September 2014. Maybank and Public Bank are ranked the 3rd and 6th largest banks by market cap in Southeast Asia according to Bloomberg. So these are the kind of statistics that have come up, and we as a nation should be proud that we have developed such world-class companies, PLCs. So in terms, the reason why we are having this GTP, ETP is actually to move towards a developed status nation. So FTSE and MSCI has actually ranked us now, have moved us to the advanced emerging. So according to the ETP lab, when they did the projections, we are actually on par to reach that 15,000 USD. In fact, we will be able to reach before 2020. So this is something that is exciting. So once Malaysia moves up to developed market status, and when the workforce, if we go up to a high income nation, the dynamics are going to change. There will be more spending power, and you can see that the consumers and so many different diverse sectors will definitely benefit. So again, this is an indication that that we are on a sustained growth trajectory. So these are the things, facts that I was actually sharing with you. So World Economic Forum actually ranked us 4th among 140 countries for strength of investor protection. The World Bank ranked us 4th among 189 countries for investor protection. And to just share with you, we were here about 2 months ago for Share Investor Conference. There was some foreign retail investors who were at that event, and when they saw the statistics, they actually approached me personally and said, "Are you sure?" Because we think, we are under the impression that Malaysia is not transparent, it's highly corrupted, it's not transparent, and they are scared to invest in Malaysian stocks, because there's no transparency. But this is the proof that we are fourth among 189 countries for investor protection. That speaks, high, of what kind of PLCs that we have developed. ADB has ranked the second among 6 ASEAN countries in corporate governance assessment. So can you imagine, probably later, the PLCs themselves, he will share with you what a headache it is to do the reporting for, to the regulators. So these are the kind of statistics that, we have. And these are not by Malaysia, but by, international bodies such as the World Bank, the World Economic Forum, Bloomberg. Another positive sign is Malaysia has one of the fastest growing working population. About 11% of our population will be entering the workforce. We are second only to the Philippines. So what does that mean? That means increase in consumer spending power. So in terms of, this is on the macro side. So in terms of Bursa as an exchange, last year we outperformed, but this year we did not. Year to date we are about 0.8%. But then this is only the FDM KLCI companies. But having said that, our market cap actually increased by 7%. And why is that so? It's because of the small caps. Small caps have done very well this year. It has gone up 21%. And that's why I say, if you deep down, although as the top 30, the blue chips did not do well this year versus last year, but if you look at the sectors, the constructions have benefited, the property sector, the tech, as well as the small cap. So, these are the kind of sectors. So if you deep dive, these are the kind of sectors, if you look, you can actually identify some, growth opportunities, some alpha factor. In terms of resilience, I think all of you are aware that, we are very much a defensive market and very resilient. So, ASEAN actually faced about 10 corrections, major corrections between 2009 to 2013. But if you look at it, how, in terms of the severity, I think ours is, much more lower compared to, we were not as beaten up badly if you compare to our peers. And the total count, in terms of corrections, Malaysia is only 6, and average, correction was about -8. And if you look at July to September 2011, when all the other ASEAN countries went down below 20%, Malaysia was only -12. So it can be, for punters, of course, this is not good news, but for those long-term investors, I think, this is a good market to look at if you look at long-term investments. In terms of valuations, I think, the ROE, I think we are the highest. And dividend, I think we are comparable to Singapore. So average is about 3%. So again, for those who are looking at dividend yield, I think some of our PLCs are, it's good to look at. Again, in terms of exposure, as I said earlier, we have homegrown companies that have gone regional, and some of them have gone international. So, it's good to actually look at, and deep dive and go into some of the companies and also sectors, and see what is good for your appetite, your investors' appetite, or even for yourselves. So having said that, that is just an overview of, I just went through briefly about, that recent story that, we are a market on the move. We have issues. I'm not saying we don't have issues. We do have a lot of issues, but we are addressing it. They are taking, pains, particularly, those involved in the GDP and the EDP, to bring down the deficit, and to look at other issues as well. They are working on it. So there is, they are working slowly to get the rationalization going on. The GST is definitely coming on. So there are homegrown, just like every other country, we do have our issues, but I think we are on the right direction, and we are like Bank Negara is confident that from the statement that they issued, because they've increased the OPR, and the reason is because they're confident that the economy is going to go, is going to go up, and it's going to go on a steady pace. So that is the good news about the Malaysian story. I just wanted to note out, this is more for the Bursa. I just want to talk about Bursa Marketplace. This is actually a tool that we introduced in April, launched. It's for retail investors, but I thought that it would be great that, it's also a good tool for those who are interested in looking into our stocks to go in and check it out for yourself. So we call it market in the pocket because you can access even through your phone, your smartphone. It is simply, it gives you exposure to daily exposure. Information about stocks, recommendations. What is unique about it? It has this S&P alpha factor. It's actually a tool by S&P, which is usually used by institutions, but they have offered it to Bursa Malaysia, and now we're offering it to retail to sort of learn about the market. I think the reason why we came up with this is because a lot of young investors are not really interested in investments in the stock market, and even if they do, they're actually looking out to the US or to Hong Kong. So we thought that this would be a good way for them to get their hands dirty, come in, just go into the website, log in. If you register, you can actually create portfolios, but even without registering, you can still access it. It's free. So this S&P alpha factor actually allows you to rank the stocks by the 5 criteria: the price, momentum, valuation, growth potential. So it sort of gives you a hand to learn about creating your own portfolio. And what is the good thing about it is you can actually go in and screen the stocks that you want to screen based on either the price or the market cap, PE. So you have all the choices for you to just click and go in. And then from the ticket page, you can actually get the profile of the company. So you get the profile of all the companies that are on Bursa Malaysia. So it is a good tool, and it's free for you to actually start learning about Bursa Malaysia and the companies on Bursa Malaysia. It also has research reports from opinion leaders and reports from and also research reports. So you can see Mr. Ken's face is here. So you can also go in and there are about more than 4,000 reports that have been uploaded. So you can just go into Bursa Marketplace and get your hands dirty. So with that, I thank you. Any questions? Sorry.
Thank you so much, Ms. Melanie Acho. Another round of applause, please. Okay, next up, we will have Mr. Leong Xiu Yin from OLDTOWN White Coffee give us his insights. Thank you. Ladies and gentlemen, I hope you all have a cup of coffee, white coffee especially in Singapore, before you come for this event. By the way, we have 10 outlets in Singapore, so feel free to drop by our outlets and enjoy our white coffee. Okay, today, myself and my colleague, Mr. Synopsis, will give you a little bit of background and ideas on our operations. Okay, I shall commence on our by giving a little bit of background, because I believe that some of you may not know the history a little bit. So I'll just try to do a very quick summary of OLDTOWN Berhad in a few words. Actually, we started our operations in 1999 with the successful commercialization of the 3-in-1 white coffee, the one that you see in supermarket, hypermarket. So after 6 years later, we found that actually the product is well received by the market, and we went on to the cafe operations in 2005. Okay, and back then, actually 2005, we don't have that type of kopitiam chain in Malaysia, and actually we saw that space. So we managed to capture that market since then, and today we have about 200 outlets in Malaysia itself and about 40 outlets outside Malaysia. Okay, so the market from 2005 to 6 years later, in 2011, we took the company public, and the market cap actually increased by more than 200% since our listing in 2011. So today, our products actually, the 3-in-1 products can be found in about, or we exported it to about 40 countries around the world. Okay, and most of the countries that you can see here is in Asia Pacific, and this is actually in line with our corporate vision actually to be a leader of white coffee in Asia Pacific. So what we are trying to say here is that our target will be still Asia Pacific, because we believe the taste profile in Asia Pacific is still what they call that, very suitable, right? Okay, we have several category of products. From the original white coffee, we do the variant in hazelnut, in few other sugarcane and whatnot. As you can see from here, from 2007 to 2014, our year end actually is 31st March. The revenue increased by about 6-fold, from 31 million to 175 million. Bear in mind, this is just the 3-in-1 division, because we have the cafe operation. Later my colleague will explain to you. So this segment actually enjoyed rapid growth since 2007 until now. And looking at the breakdown, the foreign market actually took over our local market share in terms of the breakdown of the turnover. And today, China, Hong Kong, Singapore contribute about 80% to our export revenue in this 3-in-1 cafe. We rank number 1 in Singapore with about 28% market share. We rank number 1 in Hong Kong in the white coffee segment, all this about 49%. And we rank number 1 in Malaysia with 35% market share for white coffee. So, knowing that Hong Kong is a very important market, of course also as a point of penetration to China, we invest quite heavily in promotional campaign. For example, in Hong Kong, we have advertisement that wrap over all the pillars, some of the station, just to have that full eyeball effect, to all the consumers, potential consumers. So here you can see some of this promotional campaign in Hong Kong. Okay, last year, rather just ended 31st March 2014. China market actually is the largest export market for our 3-in-1 coffee. Our initial marketing plan is quite successful, because at the first phase, actually, we are targeting all the coastal cities from Guangdong all the way to Beijing. These are the rapid, what you call that, cities that are going through rapid expansion in terms of growth, economic growth. And now, actually, we are moving towards the little bit inner cities, the second-tier cities like Hubei, Hunan, Henan. And to help us to achieve our sales target, we do have several reputable distributor appointed at the northern China, the middle China, all right? And on top of that, we have a comprehensive plan actually to tackle the China market. Because as you see, China is a big country. So besides the conventional distribution model that we do the modern trade, the hypermarket and the mini market or the mom and pop shops, actually the more important platform that will lead us to further grow will be the e-channel. So what we have done in April this year, actually we set up a flagship mall, on this tmall.com, whereby the consumer actually can purchase our product online, and then we have the logistic company to distribute our product to the consumer. So if you try to log in yourself to tmall.com, let's say, you can see, you can purchase our product there actually. So this is really much convenient for China, and also to cut down our setup costs or distribution costs in China. Although the margin will be a little bit thinner because you have to share with your logistic distributor. So with that, I'd like to pass on to my colleague here to talk about our F&B operation.
Good morning, everyone. My name is Absing. I'm the appointed investor relation consultant of the OLDTOWN. Some of you will meet each other before during next year international, as well as Nine Holding about 2 years ago, 212. Today I'm here to promote to you about OLDTOWN. I start the stopwatch when we speak. Now we will spend about 7 minutes. We have been given 45 minutes. We hope every one of us will work together and let us have a full appreciation about what we need to share with you, why you need to buy the OLDTOWN stock. This OLDTOWN, it works in this manner. When we start with this 3-in-1 coffee, show you this 3-in-1 coffee and an onion coffee. When we show you the coffee here, doesn't mean that we bring it here, we bring home. No, we're going to leave it here as a sample for all of you to collect one and try it out. Okay. You see, when you say you bring here, you bring back, you put a cook and trade out of the door, you're lost on that. Okay. When we start the Operation Café back in the 2005, there's only one cafe in the Ipoh. And we realized this, how do we speed up the process? If you want to copy exactly like Starbucks, you are not a Western cafe. If you want to copy exactly like restaurant, you are not a full-fledged restaurant. Then we turn ourselves to become a modernized casual dining restaurant. When you come here to enjoy a cup of white coffee, at the same time, your tummy start hungry. And we serve you stuff from breakfast, brunch, lunch, afternoon tea, dinner. After dinner, can we sleep? We cannot. We need to eat supper. It's an Asian culture. So with that, the business model called 7-11, 7 a.m., 11 p.m. Football season, 24 hours. That is how we're able to grow from the back in 2007, 75 to the first quarter of 2004, about 238. This we cover all various countries. Next. 238, we have about 200 plus in Malaysia, Singapore 10, Indonesia we have about 16, China we have about 3. Okay, lately, when we work, you also have to understand the business. Let's say we say Postbox Singapore, Cumulative Singapore. If you keep on focus on the student group, college student, and when they start graduate, they earn a more better living income level like you as a dealer. You start feel that, hey, come on, these people is damn noisy, play around with the Wi-Fi shouting like a monkey. Can we have a better outlet? Then we are evolving on the generic outlet. Later I'll show you a photo. We move to signature. It means we charge you more expensive, 20-30% more expensive. I give you a better dining environment. You can order a la limit, that kind of menu. And you feel yourself belong to PEMD, professional, manager, executive, businessman group. And we move around. We start feel that in the city life, people touch and go, hit and run, no time. Pass through the MRT station, the LRT station. I just need a cure. I just want to grab some coffee, buy some toast. Even though I cannot carry away the chicken egg, hard-boiled egg also never mind. Then we come out the queue. Queue is more located, for example, like MRT station, theme park, CBD zone. You work. In certain hotel, example like Carlton Hotel, they don't have a big space. 300 square feet, taking a living, we can open a kiosk. That shows that the flexibility of the business model. And we move along, we go to the next outlet called the Grand. The Grand immediately hit the upper class. The selling price is about 40 to 50% compared with generic. When you come to about 40, 50 years old, you come with your grandchildren and your parents or whoever, you want a cozy environment, look like 5-star hotel, and you don't mind to pay more. And for our survey, we realized this group, despite our target group to patronize our outlet, we also have another young couple group. They come here, drink coffee, they don't eat food because they say food expensive, but they like the romantic environment. At least the girl say, I love you. The guy say, me too. Show you the photo. Okay. When you have a different outlet, you have different capex. Let's say that when we start with if you say Grand Outlet, investment is more expensive, 1.2 million. Signature about 900,000, generic 700,000, and basic about 300,000. When you come to Singapore, if you wish to become a franchisee OLDTOWN, then we will quote in $, based on the local scenario. Okay, this is I explained to you. For the Grand Outlet, will be premium class, and for the signature is more for the upper class, and generic is a mass market business model. For the basic cure is a fast-moving market. Next, you see the Grand. You design it like back to the good olden day, like Shanghai day, and there's a 5-star hotel style, a very good environment. You have to pay 50% more expensive, but the presentation is the nasi lemak, but the nasi lemak with more dressing, more decorative. You feel it, this I love it. Okay. Signature. Signature, the guy say, walk in, standard method, I don't love it. I want you to fry the kway teow for me on the spot, fresh and nice, and we do it for you, 30% more expensive than normal outlet. So these are generic. This generic outlet is where you see everywhere you have. Let's say in Singapore, we are slowly revamping the outlet up. We first start in Novena Square 2, then we revamp it a bit more modernized. And next, Cure. Next one. Okay, this is a Cure outlet. Cure is this is the Kuala Lumpur City Centre KLCC shopping mall. This outlet is not big. We ask for 500 square feet, they give us 300 square feet. But the business is doing quite well. 1 month can do about 150,000 ringgit per month. A lot of people come and go. Okay. Evolution of the Café, we started first in Malaysia, expand to Singapore 2008. We signed the master license for Java and Bali in 2010. Then territory for China, only Guangdong province and Macau. Because from Hong Kong we moved there, we are not everywhere in China yet. And we signed the master license for Australia and the rest of Indonesia. Okay, for Australia market that we just appoint a master licensee, OTK Australia, Samantha Hart, and they were targeted to open in the first half of 2015. Okay, why we select Australia? Very simple. If we study the demography of the student in the Sydney and Melbourne, a lot of Asian students, especially from the Singapore, Malaysia, and you went there, very crazy. You see, people line out to eat roti canai, mama food, nasi lemak. This is craving for the food. And we have other competitors from Malaysia who went there, who really make it quite a good sales. Papa Rich, we are OLDTOWN. So when Papa Rich went there, we also do our competitors survey, how much you make. We ask them, they say, hey, monthly sale, I can make about 400,000 OC per month. No. When we compare with Malaysia, monthly sale is 40,000 OC per month. Wow, crazy. It shows that there is a demand, people willing to pay. Therefore, we are going into the market to really have existing demand from existing customers. We are not going in the market to convince the Western people to eat steak, to eat fish and chips, eat and roti canai. No, it's very difficult for you to make that happen. How the Hong Kong restaurant can be so popular in the Canada? Because so many Hong Kong there. Simple idea. Key financial highlight. Okay, this is show you that the compounded annual growth rate for the 20 years from 2007 until 2014 is grew about close to 20% after the past 7 years. Next. Okay. The summary financial performance, just do a quick snap. Okay, when you read from our website or annual report, 2011 is a 12-month account. 2013, because we changed the financial year end from 31st December to 31st March. Therefore, you can see the revenue higher, but and the profit higher. But 2013, 14 effect to the normal. In a simple word, the profit from 30 million to 40 to 50 million for the past 3 years. Okay. This slide is with the Philip. You can ask from the Philip. Philip can send to you soft copy, no problem. Okay. When you invest in the company, you always ask this question: the company make money or not? Yes. The company have cash or not? Yes. The company still in net cash position. Cash in the bank about 100 million. Net cash 75 million. And shareholder fund about 72 cents. Okay. The market price today about 220. Okay. Okay. If a company make money and they forgot to pay dividend, oh, that's not good. If a company make money and set a policy, every $1 the company generate, 50% will pay out as a dividend. And that is the company you want. Then show me your track record. You say you're #1 student in the university. How much you score? First financial year end, payout ratio 53%. Second financial year, 55%. The third financial is this year. The company has paid out the interim dividend 3 cents. The next dividend will be AGM 10 of September. One approved, another 3 cents. Total the payout is still 55%. In here we show you very clear. Dividend paid and the profit generated by the company. That's why you can have an actual payout ratio. So the next. Dividend payout policy is 50%. Okay. Next is a corporate exercise. Corporate exercise, the company just completed the bonus issue 144 in 28 January this year. So for those investors who invest, they have 25% additional share in the account. Okay. The foreign shareholder list, the OLDTOWN International Kenanga is the group of the businessmen who found the company since 1999. After listing, they hold this block of share 57%. Based on the old payout capital about 330 million, you're talking about 2012. Foreign fund 4%, local fund 14%. At that time, the share price was be about $1.30, and the price moved to the peak of 330 before bonus share adjustment. After bonus share adjustment is 270. The latest shareholders thing show you one thing that the OLDTOWN International had diluted because new share issue 10% new share issue 43. Foreign fund is about 37%, local fund 5.7. What has been changed behind the scene? First, market cap 330 million increased to 1 billion ringgit. Second, institutionalize the shareholder base. Third, internationalize the shareholder base. Today, you take a look at 37%. Various announcements have been made to the stock exchange. Franklin Templeton Group worldwide 7.3%. Artisan Partner Singapore office 5.3%. Battelle International Capital Management San Francisco 5.3%. Mauer Investment Management Canada 6.45%. The top 4 largest foreign funds hold this block 36%. Out is 36%. It shows that the company has been went through the due diligence, went through by all the stringent fund managers. Among the fund manager group, they are monitoring every 2 weeks, close to about 50 fund managers from worldwide who hold the share. The shareholder used to be start from Malaysia, Singapore, Hong Kong, now become Japan, Korea, US, Europe, Germany, and so on. There we have a very robust investor communication program that we talk to all of them to remain the interest of the company. Okay, I think I will try to cut the presentation short. We have spent 20 minutes. We still got another 25 minutes for Q&A. Please take this opportunity to ask as many questions as you could. We don't wish to cover too long the slide. The original slide is could be 80 pages, but we don't have 80 pages time to present. Mr. Leong is a general manager of corporate strategy as well as take care of investor relations. He also takes up for the opportunity of the company and so on. And probably address this question. Okay, the first few who ask questions will get the coffee first. You see, in this world, the pen, I need to refill coffee already. First class coffee from Nanyang. The rest is instant coffee, so sorry.
So when you say white coffee in the white coffee market, what is the distinction in the white coffee? Who are you
Okay, this is a very interesting question that most investors actually is interested in. I think let's start a little bit on the white coffee. I'm not too sure many people are aware that white coffee is a formulation of 3 categories of beans. Contrary to many believe that white coffee is just the black powder mixed with milk or creamer, and then you have white coffee. Actually, it's not true. Today, I'm here to erase that from your memory. Actually, white coffee is a unique combination of Arabica beans, Robusta, and another local beans in Malaysia. Okay, and of course, you have sugar and creamer. That formulates our 3-in-1. And we cannot patent the statement that OLDTOWN invented white coffee, but we proud to say we pioneered the development of white coffee in Malaysia. And that, our success invited many players into the market. We have Power Root under the brand called Ahwat. I'm sure it's quite popular also in Singapore. We have Check Up, probably not so popular in Singapore. We have Nescafe also enter the fray to produce white coffee. So this Apple Super Group in Singapore, right? Super is a giant in Singapore. Okay. So everywhere in Malaysia, Hong Kong, China, Singapore, we meet this group of competitors. Okay. What we are facing today, the competition, the intense competition, is not something new. Okay. And how do we able to convince our investor to say, hey, we are successful? I can only share with you one thing. We didn't drop our price, but we able to maintain our profit margin. So what our strategy is actually to protect the margin instead of gaining market share through price reduction. And because from the margin, we can see that there's still strong followers despite our product at a premium to the few competitors, actually, the pricing that I mentioned just now. So the unique taste is ultimately the differentiation point for our product.
This gentleman asked about the white coffee. You see, in this manner, I just add on what is mentioned. Western coffee chain, Starbucks, San Francisco, or independent coffee chain, the first cup brew up is black color called espresso, where you mix with the milk, then it becomes cappuccino, cafe latte, and so on. That is the way they call black coffee or white coffee. And when we come to this part of the Asian culture, the Hainanese migrant come to this part of the world, Nanyang, Malaysia, Singapore, and we go to the kopitiam, we drink the coffee. Most of them will have the black coffee. And what's the difference why it puts out white coffee? In scientific formula, we work in this manner. Ordinarily, you go to a coffee shop, you will either use either one of the bean, Robusta or Arabica. Whereas in OLDTOWN, we use 3 types of bean: Arabica, Robusta, Liberica. It's available in Malaysia and Indonesia coffee farm. Second, during the roasting process, ordinarily black coffee, we try to add a lot of sugar, about 80% caramel. Whereas in white coffee, we try to use less sugar, 20%. So you remain the robust taste of the coffee. Okay? When the coffee served, you go to the shop, hey, coffee, oh, black up. Say, coffee, I add milk for you. When we add the milk, the condensed milk, we don't add any ordinary condensed milk. We have this special manufactured by the FMN, special condensed milk with a formula to add in our coffee before we serve you. That's where in here, you got 3 types of the different bean and less caramel. And when we start the white coffee back in 1999, we're facing a very big issue. Now, whether you are doing a coffee powder or you use 3-in-1 coffee, this will conquered by this name called Nescafe. Nescafe invented by the Nestle since World War I and World War II. When we start 15 years ago, they are 50 years old. Today, we are 15 years old, 1-5. They are 75 years old. So when we start, you have to ask yourself, the whole world is conquered by Nescafe. You come out another Nescafe, you just like another super. Where's your niche? You have no niche at all. So we say, why not? We come out 3-in-1 white coffee mix. 15 years ago, the whole market, white coffee market share is 0% in Malaysia. 15 years today, the whole market, 35% is white coffee, 65% ordinary instant coffee, the Nescafe market. That gives you an overall view how it works. Today, who control the pizza market? Maybe Pizza Hut, Papa John. If we can come out something Singaporean Tom Yum pizza, it will hit the market, it take market share. That's how the business grows. Okay, I hope I answer your question from business perspective and the product value perspective.
What's the ROE?
We did calculate the ROE during the IPO listing day. It's close to about 15, no, about close to about 12 to 15%. But I cannot answer you ROE very accurately. You know what's the issue? The issue here is when the ROE is profit divided by equity. Okay, the profit is growing for 35, 44 to 50 million. But the equity has been growing because initially the payout capital is 330 million. When you issued 10% new share, it becomes 363 million. Then after the golden issue, it becomes 453.9 million. So when the equity base grows faster than the top line, the ROE naturally drops. Okay. There's two ways you see the company when you, one way is we say textbook formula, ROE drop, don't buy the share. The other way is ROE drop, you should buy the share. Why? Because the company is expanding its share capital base to in position for the bigger game in the future. Every 10 years is a recession. Every 5 years is a mini crisis. Should you see the market slow down in 2001, 2015, there is the 100 million cash in the bank account of OLDTOWN. There is a chance you will acquire the company to grow it bigger. So the ROE temporarily drop doesn't mean that the company is not performing well. So if you take a long-term view of the company, you will see that look, don't follow the textbook. Follow what the company try to do, capture for the bigger sales. I take a very good example like PhillipCapital. I have a word with Mr. Lu. You spend a lot on the advertisement. It will hurt the ROE, but never mind. You will bring in a lot of future business and make PhillipCapital the leading market in the retail.
Then what about the PEG?
Profit earning growth. This is a price ratio growth ratio. Price ratio growth ratio is if you earning and price ratio growth more or less the same. We show you just now for the past 7 years about 18%. For year on year is about, it's close to about 15. Slightly slow down in the year of 2014 compared to 2013. If you take single 2-year comparison. Okay, PEG growth also a very magic formula. This magic formula in the sense that is if the company in a very fast growing phase, the PEG growth is very good measure. Unfortunately, in the consumer sector, it's fairly stable, very cash generative business. PEG growth may not be able to run as fast as semicon company, but it will be more like a constant growth in line with the disposable income and GDP growth and consumption growth. But one thing good is this business, if you take a look at operating cash flow, on average it used to be 40, 50 million. Last year, operating cash flow was 60 million. So it shows you that PEG growth is low, but the cash is standby for future earning growth prospect. Oh, don't give, otherwise you will blame me. Yes?
So I just saw the distribution is mostly at the consumer level.
Yeah.
But the commercial, you don't cover something like selling volume.
Distribution level.
Okay, at the moment, we only sell our products in a cafe outlet or in 3-in-1 state that you see. So we are not doing that so-called, probably you're thinking about OEM. No, not yet.
That plan
Not in our planning for the next few years because we still want to maintain our coffee brand as a premium brand in the market.
then the next question is, because right now you said that Papa in Singapore we have more like the Paris graduate and all this kind of competition. I mean, how address this kind of competition. And then third is I realize OLDTOWN I mean there is some cooperation with DKSH. I mean, could you tell me a bit more about this?
Sure. Okay, I'll take care of first question. That's the most easiest actually. 55% of the revenue of the group total revenue, let's say we are about 380 million last financial year. 55% actually contributed by Café operation, right? And 45% contributed by the 3-in-1 coffee. So on your second question is regarding the competition. Okay, Papa reached up to now about 80 outlets in Malaysia. We have 200 outlets in Malaysia. Okay, and we're still growing. And in order to capture various segments of the market, just now we already actually roll out the signature, grand, kiosk, and generic. And what we are trying to do here is that if the consumers actually prefer something affordable, they will go to generic. And if they try to differentiate themselves from the normal consumer, they will go to either our signature or grand. Unlike Papa Rich or the other competitor, okay, let's compare it. I would say Papa Rich is our direct competitor because their food and drinks are very similar. But come to the specialty coffee, which is very popular nowadays, even in Malaysia, we don't see them as a competitor because they don't offer full range of food products. Okay, they only offer premium coffee, and mostly we look at that the segment is frequented by the yuppies and young group of people. So our restaurant actually cater for all age group. Okay. The third question, DKSH, yeah. DKSH actually is a distributor focusing on modern trade. Modern trade we look at here as those hypermarket, supermarket, or mini market. So in Malaysia, we appointed them because DKSH is a very, what do you call it, established distributor for many products. So compared to, let's say, if you set up your own distribution company, let's say OLDTOWN set up its own in-house, you will not be able to reach that kind of penetration compared to DKSH, for example, because there's economy of scales for them to move not just OLDTOWN products. Actually, they move all over the country, different category products, so they can push our product to many diverse geographical areas compared to just us. So that's why we have DKSH. It's a listed company in Malaysia.
So specifically what they have done?
They help us to distribute.
So over the world or just in Malaysia?
In Malaysia, in Taiwan, in Thailand, because the good relationship with them are established in Malaysia, so we are comfortable with working with them. So we actually appointed them in Thailand and even Taiwan, and there's Shanghai as well, because Shanghai is not so much of a distributor but as a logistic provider, because when there's an online order, DKSH will help us to send the goods to the consumers.
I just try to add on what Mr. Leong tried to say. You have to understand DKSH is an international trading hub. If I come and talk to Walmart and Tesco, one product, I don't waste my time, I will pay. If I in DKSH, 300 products, from diaper, from sugar, from coffee, from bread, from everything, then the Tesco say, creditor, how much? So you work. DKSH helps us in marketing, get the sales space, collection of the money, distribution, and the point of sales. If today I come out with iPad, where do you go on to sell? I get international distribution house. Immediately I get 10,000 points of sale. That's how Even if you go to the coastal state of China, Walmart, Arjuan, Artimark, Jusco, Tesco, all these hypermarket, supermarket, you can see OLDTOWN product is listing on the shelf. In any fast-moving consumer good, the word called fast-moving, fast first reach point of sale to the hand of consumer, you win. You want the margin, you take 10 years, you lose. Okay. The next thing to answer you is on the positioning. In Malaysia, we see Toast Box, we see Kunali. Akun is not in Malaysia yet. The direct competitors will be Hainan Kopitiam, about 30 on the shop. Papa Rich, about 70 to 80, because they did not update their website very regularly. The statistics may not be up to date also. What we need to do is, we spend 1 million for one outlet. Papa Rich will spend 2 million. They need double the space, they take the corner lot. So for franchisees, very high hurdle. And you need to pay a very high rental to start with it. Because of that, the entry point is different. If we sell 1 cup of coffee 4 ringgit, they will sell 1 cup of coffee 6 ringgit. It's higher price. And when you go in the Papa Rich, they project and feature themselves green color. Green is very close to Muslim market. So they got a lot of Muslim market background. So it works quite well. They try to create a niche in the market. At the same time, they also serve dim sum. They also serve roti, braised, and kari and so on. So everybody have a niche. The market is big enough for everyone. But because of the high hurdle income, all of us start almost the same time, 2005, 2006. OLDTOWN grew to about 220 over, and they are still about 70, 60. And the business model is very different. When we start our franchise model, we try to support franchisee more. For every $1 of sales, franchisee can easily make about 60 to 65% gross profit margin. Okay, we also own half of the outlet. Whereas for Papa Rich, they did change the model in a very early day. 90% is franchisee owned. So when the franchisee owned, how do I make money as franchisee? I sell the food to you very, very expensive. The gross profit margin you can make is only 50%. I selling the coffee, the bread, the noodle to you and make from there. Then, if I as franchisee, I make less money, I cannot grow bigger, I cannot grow faster. So that is a different mechanism behind the scene to show that why people cannot grow too fast. Until and unless your name is called McDonald's and KFC, I don't need anybody money. I can cover the whole island with all my money. That is a different ballgame. Yes?
You're going to set, I understand that you're going to set up 2 outlets in Sydney or Melbourne, right? Competent to actually fiscal outlets, right? How do you go around the Australian currency? That's the first question. Or you're not even concerned. The second one, I mean, big inflation and all that. Prices of food, are you going to, you say, and the second question is your core business is coffee. I understand you said 3 brands. Where you get them source, is it from supply or you actually have investing interest in it already? Have one thing in it, and then you only have the own logistic, like you just now said. Do you have the store supply? Because due to value changes, how do you?
Okay, I try to summarize the question. The first question, who run the Australia outlet? The second question, you manufacture coffee. How do you manage your supply chain? It's as simple as that. Okay. The first question is because the slide, we don't want to make it too long. We appoint the OLDTOWN, it's OTK Australia Senang Pahang. They own a subsidiary in Australia called OLDTOWN Australia Private Limited. They had a local managing director, is a Malaysian, called Mr. Mansoor. He has been in the F&B industry and the retailing industry for the past 20 years. He will be the person who instrumental who run the outlet on the ground for Melbourne and Sydney and export opportunity elsewhere. There is a physical Malaysian who work, but he's a PR Australian at this moment. Okay, when it comes to the supply chain, that before the coffee, do we have any coffee bean or whatever you want to talk?
Okay, the concern about beans is not an issue because we always, for our plant, actually we don't process the raw beans. What we have done is actually our plant is getting the bean powder already grind into powder form by our suppliers our supplier import the beans, and we give them the formulation. Of course, they won't know exactly. They just grind the beans. Okay, you grind X%, these 3 category beans, and send to our plant, and we will do our own mixing. So our plant actually is mixing, blending, packaging.
How do you maintain the stable prices of coffee which is
Because of our order, our size, consistent size, we have a 1-year forward contract with this supplier. So regardless of the fluctuation in the 3 category of beans every day or every month, it won't affect us because every year we have that. So the expiry date of a current agreement will be in March next year. So we have to worry about that again. Yeah. So coming back to inflation and all this, we believe that there will be a certain transitional period. Everyone will be a little bit of so-called adjusting their spending behavior. But we believe that food is still a basic product that you still have to consume. And we don't think that that adjustment, if it happens, it will be negative for too long. Because after a while, people still will get back to their normal lifestyle. So either they put less here or put more there or earn more money and then go back to them. So I don't see inflation as an issue overall.
Before you move to the next question, R&D is a very small sum in terms of the revenue compared with the revenue. You know very well, you understand the super group model very well. So to share with you, because OLDTOWN business is not really big enough industry on coffee. Last year we produced about 9,200 metric ton. And 2014 we forecast about 10,500 metric ton per year. We are still relatively small. When you're relatively small, you want to work on cost-effective efficiency manner. We buy the spray dry instant coffee powder from outside supplier 2 to 3, including Haku, and we lock in the price to cash market. With that, we do our proprietary mixing. Okay. How about copy the model of super group, non-dairy creamer plant, instant coffee plant, spray dry, freeze dry? Then you are facing a problem. When your sales slow down, you underutilize, and you start with the inventory, you start with the supply chain. I know very well a lot of people have follow the super group Q-to-Q result. One of the main reasons is commodity price to drag them down. The other reason to drag them down is the forex. That's why it's up and down very significant. You read the account, profit after tax, forex gain and loss is up and down very huge before comprehensive account. Whereas you read OLDTOWN account, forex is very small. You can detect from profit and loss account. You can detect from cash flow account. Net cash increase and decrease of the year. Forex fluctuation is very small before you divide in cash at the end of the quarter of the year. So that gives you a better assurance. Because sometimes we say it will not affect it, say, no, it's a graphic and look, that count the big number there. No, we show you the number. Okay, gentlemen. You see, this kind of short-term question is day-to-day question, minute-to-minute question. It's so crazy. It's just like the climate just over when the next climate comes again. Wow, it's so difficult. Honestly, share with you, from the day listing until today, we did monitor the shareholder movement for every 2 weeks, but we're not able to monitor every day. This question, we have received a lot of phone calls from the shareholder, fund manager, and analysts for the last 2 years. They say, why $2.20 dropped to $2? When the price recovered back to $2.20, nobody called at all. The only information we can share with you, we have about 40 to 50 fund managers all over the world who hold the OLDTOWN stock. The big one I already mentioned for the public announcement. The small one holding for 1 million, 2 million, 3 million. And fund manager is very beautiful creature and animal. They love it. They buy unlimited program buying, push to the peak. One day in the investment committee commission, the chairman said the coffee is so bad taste. Then we detect the shareholder rate, 2-3 million sell by one single fund manager house. That is sometimes it happens. The most insulting is after they sold already, a few months later when the share price moves, they buy back again, the same fund management house. But we cannot openly tell the whole world. We cannot do that. It happens. So with this kind of short-term fluctuation, that we are definitely beyond the control, number one, because some of the fund managers choose to do on-market trading. They call Philip, sell all 3 million to waste time. And some of them choose to do off-market. They do contact us. Do we have any fund manager like PhillipCapital mentioned would like to do off-market? Then the transition will do off-market. This kind of price fluctuation does not happen. I'll give a very good example. If I remember the date correctly, somewhere in June 2013, there is a US fund manager do a program buying. From $3.10, he can push all the way to $3.30 in one single hour. It was so beautiful. And we see local fund managers also jumping and buy. 1 month later, they call, why the share price drop? How to answer when people do program buying, you also want to follow? See, the same thing here also that if you feel the stock is what you want, then you need to advise your client accordingly that accumulate the stock slowly, accumulate the stock closest to the exit of the dividend or closer to the exit of the bonus. You may make some small gain along the way, then will be better. But we really cannot advise you when is the best timing. Because the best timing, when you look at the history, it could be the worst timing. See? We have this bad experience before that somebody bought at the peak and they start calling management and question why the share price don't perform. Somebody bought at the low. They're so happy, they call they will call the management. They never say management, you're good. They say I'm good. So I really don't have an answer. Sorry for that question, no coffee for you. I will give you, don't worry. Our time is almost out already. It's about 45 minutes. You see, the tagline of the it's over. The tagline of the OLDTOWN is not. We used to start our tagline for Café outlet called "Take your time, sit on the chair long, talk as long as you like." We realized that not only the table turn around, the chair turn around very slow. So we changed the tagline, "Aroma of good time." After enjoying the good time, it's a time to live. We need to do business. So thank you very much, and I see you again.
Thank you so much, Mr. Leong and Mr. Tan, for the wonderful insights on OLDTOWN white coffee. Okay, last but not least, we will now have Mr. Chan Tian Yu from Kenanga Research give us his insights on the investment strategy for Malaysia. Mr. Chan.
This one. This one? Yeah.
Hi, good afternoon, ladies and gentlemen. Thank you for giving me this opportunity to present our investment strategy for third quarter. Not too sure whether it's a good timing or not because this slide actually we done sometime, I think 2 months back. We always done a quarterly, I would say the update. So we are actually another 1 month to due for the fourth quarter investment strategy. Bad timing in the sense. The buying level that we thought 1835 almost there already. I think last week we met a low about 1837, so we are there. But the good news is I think after this correction we should see a better market at least I think in the fourth and the first quarter. So most of the I would say the idea will be about the same. Probably I think we will have some changes in our topic, but I think you can roughly use this as a guidance for the next quarter as well. Before I talk about the market, just to give you some brief idea about the Malaysia economy, I think in terms of growth, first half we actually saw quite a strong growth. But I think for the second half probably we'll see some moderate in terms of growth because the base impact, especially coming from the export side. I think export for the first 6 months was actually quite strong, high, I would say high teens kind of growth for Malaysia export. But I think that actually the trend actually started since third quarter and fourth quarter last year. So going forward into second half, we probably will see the growth start to come down maybe towards the lower tick compared to the high teen side. But nonetheless, I think for the full year, we should be able to see at least, I think, 5.5% GDP growth. The growth, apart from driven by export also, we think the growth will mainly, I think, coming from the domestic investment. That was actually one of the major growth because of our ETP projects. And also, I think the private consumption will still remain very steady, especially, I think, before the implementation of GSC, we probably will see some, I would say, the advanced spending before the GSC being implemented, I think, April next year. Of course, I think the worry is on the inflation. I think so far the inflation is likely, I think, about 3.5%. With the GSC, definitely we are seeing slightly higher inflation. Needless saying, I think if, let's say, government start to cut more subsidies, the inflation in Malaysia will probably increase more. That's why I think Bank Negara, I think, recently just increased our interest rate by about 35 basis points. Although we don't entirely agree with such a move, because we thought that the inflation is not really come from a demand pull kind of inflation, it's a cost push inflation, and therefore I think your living cost is increased, and we shouldn't see such a, interest rate hike. But so this, to our surprise, the central bank actually start to increase the interest rate. When the market is still looking for another 25 basis point increase in interest rate, maybe in the coming September month. Again, I think we still hold our view. We think that cost push inflation, we shouldn't see a hike in interest rate. In terms of Ringgit, we still think that the Ringgit will be volatile. I think that the Ringgit prospect will still hinge on the US, I would say the interest rate directions. Let's say if we think that the US interest rate will stay at least, I think, unchanged for the couple, at least for the next 6 months, then probably I think the Ringgit should actually maybe to trade at around 320 to 325 against $1 in the next 6 months. In terms of market, I think all the while, I think for the last few quarters, we have been talking about the liquidity. We think that liquidity is one of the main factors to support the Malaysian market. If you look at the excess liquidity condition in Malaysia, the excess liquidity is still very strong. We have, I think, close to 300 billion in the banking system. The excess liquidity, how we measure, basically we just take the total deposit in the banking sector minus the total loans. Slightly off from the peak, about 20 billion only. Still, I think this is very healthy level if you look at the historical. I think during the year of 2009 to about 2011, we saw some reduction in the excess liquidity, about 50 billion, but that time the market still holding up very well. In fact, the market back then was still within the uptrend. Of course, the only worry is when the liquidity reduced in a very short time frame, say about 100 billion, then probably the pressure will be there. Then they will give some pressure to the local market. So at this level, 20 billion, I think is nothing major to us. I think at this level, we are still very comfortable with the liquidity. But of course, I think the uncertainty will be more on the US interest rate movement, because that will actually have an impact to our interest differential. which I'll explain later. Foreign investors also start to turn net buyers. I think back then it was I think about 2 months ago. You can see I think this gray line is actually the accumulated net buying position from a foreign investors. You have actually since I think this is the third quarter of last year. Foreigner have been the main seller, but actually the 10 net buyers. I think since I would say I think it's about June, it's about March this year, they start to turn into net buyers again. So that actually helped to support the local market. But of course, I think during the time we also questioned ourselves, is that it will be a very good indication about the market. But also what we worry is that will this buying be sustainable? Because we have other reason to think that probably the foreigner will not come into our market in a very, I would say, decisive or maybe in a more aggressive way, mainly because of the valuations. This is an updated chart. I think our concern actually materialized. You can see, I think the foreign, I would say the foreign net buying position actually have been tapering since then. That actually echoed to the I would say the concern we have about valuation we have. I will show you about the valuation later. This chart basically just to show you based on our quantitative measures, looks like the upside still, I mean, having the better risk reward compared with the downside. And the technical picture also, I think at least you can see, I think CI been trending up in a nice uptrend for a number of years. Of course, I think the only weakness is some overbought position. That's why I think in the short term, this is daily chart. That's why the recent correction came about because of some overbought situation. And but the mid and small cap technically looks better compared with the CI. Of course, I think the worry is overbought some negative divergence here and there. So that correction can be, I mean, it's still possible. But of course, I think normally the seasonally fourth quarter will be quite strong for the small mid cap. So we think the correction may only come in maybe in maybe another quarter, maybe after Chinese New Year or something. Because normally before Chinese New Year also small cap tend to actually outperform the big cap as well. The worry we have, I pointed just now, is interest differential. If you look at the interest differential between the US and Malaysia, this is the 10 years government bond for Malaysia. This blue line here is 10 years US Treasury bills yield. So we take the difference. This is a gap. So you look at the gap here. Normally when the gap actually hit the 1 standard deviation above the long-term mean level, it tend to be toppish, and it actually tend to revert. At least I think try to go back to the long-term average, and I think we are actually here. So the risk of narrowing in gap is there. If that's the case, what would be the likely scenario? In order for the gap to reduce, that means to say is either your Malaysian yield have to come down, or your US Treasury yield have to go down. So I think obviously the risk is for the yield for US Treasury bond to go up. So let's say if US really increase their interest rate, that will actually put some risk to the potential foreign outflow to our market. This is another chart to draw such a conclusion. Basically, this chart here, I overlap the excess liquidity and our the interest differential. The red line here is the interest differential, and the blue line is excess liquidity which you saw just now. Very clearly, when the interest differential at the low level and declining, the excess liquidity will reduce. And normally, when the yields start to decline, you actually lead to a decline in the excess liquidity as well. So that is what we actually worry. So far, we think that the 20 billion reduction in excess liquidity shouldn't have made major problem to us, but we still have to monitor the situation very closely. Based on historical, easily we can absorb up to about 50 odd billion kind of liquidity reduction. And also don't forget that during back then, the 2009 to 2011, the Bursa market cap back then not more than 1.4 trillion. Now the Bursa market cap is more than 1.7 trillion. So they should be able to absorb more reduction in the excess liquidity. I don't have. This is not the dollar Ringgit chart.
No, just see how it will.
Oh no, we don't do such a study for forex. Yeah. Okay. Back into I think earlier of this quarter. So this is what we actually one of the reason we worry is on the valuation. If you compare with the regional market, this is basically the CI PE, and this is all the regional. This part here obviously will be the Northeast Asian market, and this is Thailand and Indonesian market here. So obviously the PER for KLCI have been I mean in the uptrend, and actually it's trading at a premium to others regional indexes. If I actually benchmark other indexes against CI, that means to say most of them actually trade at a discount to CI in terms of PE valuations. And a very clear cut, this is what we actually worried is the Northeast Asia side. That means to say for this data is since early 2011. That means to say the valuation of Northeast Asia actually at the historical low compared with CI. In other words, means CI in terms of valuation is at a historical high, at least since 2011 against Northeast Asia. So that is one of the concerns we had during the earlier quarter. We thought that because of this, we thought that maybe the valuation will actually eventually to converge, and therefore probably the foreigner may not actually want to come into Malaysia in a very significant way. That is actually what we the promise to have a more conservative stance in the third quarter. And I think what we actually concern actually materialized. I think in the very recent weeks. I think if you look at the valuation, CI definitely start to decline. Other markets start to play a catch up, and the discounts start to converge as per our earlier expectations already. And if you look at the performance, just looking at the Shanghai Composite Index, I think within this quarter it up about close to 9%. Whereas I think for CI, actually it's down a little bit. So that actually concern actually I would say the start to materialize. And earlier quarter also we thought that the volatility might actually cause some concern to the market as well. This one we done early in the quarter. Same thing I think for Dow Jones, the volatility have been at a low level for some time, and I think for CI for Malaysia, the volatility been remain at low level for some time. And normally this kind of low volatility to us is not really sustainable, because volatility tend to fluctuate within a bell curve, and once they actually swing it normally will lead to corrections. And at that point, we thought that potentially we will see a corrections. And again, it materialized recently. But to us, I think it's not really something that you need to too worry about, because the correction to us is mainly more valuation, coming from valuation part of it. Because early of the quarter, CI in terms of valuation is surpassed the 1 standard deviation above the long-term mean. And normally, this kind of valuation will actually become quite toppish, and the valuation tend to revert back to the mean. And we actually expect that to happen in third quarter. And the same thing actually goes to this study. This study we have been using to track the market for the past few quarters, and have been working very well. Basically, we track the CI movement and its consensus. This total line here is the discount between CI and the consensus. And we actually can see that normally when the discount actually below 3% level, which is also about 1 standard deviation above the long-term mean, it tends to be toppish, and it actually tends to revert back to the mean, which is about 6% discount. Using that, we actually draw a conclusion earlier our quarter. That time the consensus value is here about 1950, and if you peg at the 6% discount, meaning to say we actually expect the CI to back to about close to about 1835 kind of level. And the lowest, as I said, I think for last week was about 1837. So to us, I think the correction has been done. Third quarter seasonally is the weakest quarter. If you look at the Q&Q performance, definitely is one of the weakest for the past, I think, 13, 14 years. So what's next for the fourth quarter? If you look at the performance for the fourth quarter, it will be one of the strongest among the four. So if let's say if we believe the correction has been done, and I think probably we need to position ourselves for the coming fourth quarter and potentially the first quarter of next year, because these two quarters tend to actually give you quite a strong quarterly performance. So that will be the main idea for our fourth quarter strategy. And in terms of some fundamental numbers, we will just still maintain our year-end index target about 1960. Now we think that should be actually give us the decent upside after the corrections, because back then only offer about 3.7, but after the corrections, definitely now we are actually seeing about 6% kind of potential upside, together with the yield. Even yield for CI is about 3.3%. So in terms of total return should be about close to 10% for the CI. In terms of sectors, we actually still like the sector like building material and construction because of the ETP. We still like glove because we have the bargain power in it. We are one of the largest in terms of market share. I think Malaysia glove maker control about 60% of the world market shares. We still like the power utilities and the water utilities, and transport and logistics because of the export. I think have been very strong. As I said, I think for the first half, is export growth. I think is at a high teens kind of growth trajectory. So we want to capitalize on that. Only I think during the third quarter, we just downgraded these two sectors. I think oil and gas and property. We want to be more selective. It's not that we don't like the sector. Again, it's more on the valuation point of view, because some oil and gas stock actually they trade about more than 20 times PE. At one point, if you look at the Petronas counter, all of them actually is like at more than 20 odd times, and the recent corrections actually just reflect, I would say, more on the correction in terms of the valuation, not so much on the fundamental. Fundamental all remain sound, and nothing actually has changed. Basically, it's just a valuation. In the fourth quarter, probably we want to relook at the oil and gas and property sectors. Probably we want to relook at our rating again. But even let's say if we still maintain them as neutral, but we still try to be very selective in terms of getting ideas or investment ideas coming from these two sectors. That the only sectors that we just downgraded was plantation. Plantation to us is, I think, a bit of, I would say, below our expectation. Earlier on, we thought that we actually have a CPO average forecast about 2008 for this year. But with the strong, I would say, the production of soybean, and that actually caused the soybean price to correct in a substantial way. Now we have to revise down our CPO price assumption. I think our latest assumption was about 2006 for this year. So that's why we recently just downgraded plantation to neutral, and I think most likely will remain this neutral cost for plantation. But nonetheless, there's still some good stocks within the sector itself. Okay, that was a strategy we proposed during earlier of the quarter. We thought that it should be wide on weakness. We think that 1.835 was a good level to go in. I think the temporary bottom should be there already, so we will be slightly more aggressive in the fourth quarter. In third quarter, because of it was we expect a correction, so therefore we advise our investors to go for dividend play, because normally third quarter is best to go for dividend, because they will announce, most of the company will announce their full year or 6-month interim results, so normally they will give quite a good dividends. So that was the plan back then. In fact, we actually give out the list of to our investor when the dividend is expected to be paid out, and quantum was also given back then. So, but in fourth quarter, this is probably we want to downplay the dividend play, because fourth quarter, if we believe it's a strong quarter, then we want to be slightly more aggressive, and maybe we want to look at those stocks that have been correct substantially to go for a rebound play. These 20 stocks were the stocks we actually recommended during the quarter. I think these two banking stocks have been performed very well. AFG and Young Credit probably will take up on the list because they already hit our target price. I think yeah, back then was around 13 something. I think this target may have been met. I think the highest recent high was about 17.90 or something, or 18 ringgit. So it's been met. AFG we got it because we thought that if let's say really interest rate to move up, then they'll benefit. True enough, I think the market actually recognize it. I think these two probably a hit. Inari, even we replace with MPI, all those target price all hit because the export have been very strong from Malaysia. I think the E&E stock saw some re-rating. I would say very recently, so they actually hit our target prices. Redstone and KLCC probably we just recently downgraded to neutral, so we will definitely take up from our buy list in the coming quarter. So what we have right now, I think we're still confident. Probably I think Glove is still good. Atalaga is our topic so far. I think even Kosan or Supermax is also a good stock to look at to get exposure in Glove, especially now you talk about Ebola outbreak, all those things. Yeah, but even without that, I think that should actually a good sector to look at, because most of these companies should report a better result in the second half of the year. So just pure fundamental is worth to look at them. Logistics, I think the Medmark definitely no problem. As I said, I think export has been strong for Malaysia. Medmark basically just one of the proxy for better throughput numbers, and potentially we'll see the dry bulk index to strengthen because in line with the demand. The Nestle basically just a dividend play we have for the quarter. Probably we want to take up because, as I said, we will emphasize lesser on the dividend play in the fourth quarter. Sapra Kencana, I think is still good. We still think that this is one of the major player within oil and gas space. Petronas counter. This is one of the bigger one. The only reason for the recent poor performance was because this stock no longer be a Sharia compliant stock, because we have a new rules in terms of the Sharia compliant stocks. I think in terms of their funding structure, they cannot actually meet the Sharia requirement. So the Sharia fund had to sell it. That's why the performance was weak recently. Nothing to do with the fundamental, just because they lost their Sharia status. For those you are not aware, I think Malaysia, in terms of Malaysia stock, Sharia compliance means quite a lot to us, because we have a lot of Sharia funds. Their mandate can only buy into Sharia stocks. Let's say without the Sharia status, they cannot even touch the stocks. Yeah, or any gains from this investment, they have to donate to a charity. That is the reason why the Sharia funds recently they sold down Sapra Kencana. Another big boys that who lost their Sharia status is IOI. So for those who have IOI, so then probably you want to sell it first, because they will lose their Sharia status maybe by the next review, second half review, because again their funding structure cannot meet the Sharia requirement. Sunway, basically we pick that as a construction play, because I think they see a historical high in terms of the order books. They participate in numbers of I would say the project. I think they also participate in MLT, LLT extension. So the order book have been strong, and their property division also doing quite well. So that's why we pick Sunway as one of our top pick for this quarter. For the other two big caps, basically just for the more on the institutional players, because they need some big caps. So we have TM as a proxy to the telco industry, and Tenaga actually just a proxy to our power utility. So for retail investor, normally we have a alternative investment channel. For power, we will pick hashtag. Hashtag is one of our top pick for the big and small cap. What they do, basically they're building they are turnkey contractor. They build substations, genset, power transmission, all this stuff for the clients. They have some project in Sarawak, what do you call it? This Semaraju, ports. They have some that for the SCORE project. They have a project. Let's say even I think down south also they bid for the rapid project, Johor. Also, I think about half of their revenue actually come from the Indo-China. So they are big in Indo-China also. So the stock performed very well. The IPO was less than RM1. I think recent high was actually if you look at the price area ex dividend, this is a count dividend. I think they shot up above 7. I think we have to relook at our numbers again. Our target price again. For TN, originally we have a Redstone as our alternative investment for the small market. Recent results show that I think they're slightly bigger than expected. So we actually decided to downgrade to neutral. So we'll probably pick up from the list in the coming quarter. Although, as I said, for plantation, we said although it's neutral, but we always think that there's still good stock to look at. PSH is definitely one of them. This stock have been in our mid and small cap stock pick for, I would say, I think at least easily 3-4 quarters really. They've been performing very well. I think since our recommendation at low 3 ringgit, I think now it's surpassed 4. I think surpassed 4 already. They just announced a bonus issue very recently. The other plantation sectors, I would say the stocks that we look at probably is a CB industry, perhaps CBIP. But that is more on the downstream players. But I think with the CPO price at a low level, probably the downstream player will benefit the most. So we might actually want to relook at the CBIP as well. Other small cap, Coastal is a small cap for oil and gas. I think they've been doing very well. It used to be a shipbuilder, but actually they transformed their business. During when they're actually still a shipbuilder, market only give them about 5-6 times PE, and they have been a trade at the 5-6 times for like I think easily 3-4 years for longest time. But recently, what they want to do is that they change their business model. They want to be an asset owner. They bought. They announced already in Bursa. They actually bought the gas rig and actually they leased the gas rig to the operator. This gas rig actually in Mexico. So they actually lease it to the Mexican oil and gas player. Also, I think they are looking into more on this kind of asset. They want to like maybe look at the jackup rates as well. So all these things actually have changed the perspective of the investor. So let's say it's an asset owner, the market start to price them against the asset oil and gas asset owner kind of valuation, like maybe Alam Maritime, like Precise, or this similar kind of company. This kind of company that trade normally in terms of PE is about at least also about 12 to 14 times. So that's why the re-rating came about. The share price actually moved quite sharply. I think from about low 2 ringgit, I think to the 4 ringgit very recently, because of the change in the business model and the re-rating in terms of their valuation. We still like it. We still think that the business model will continue to support. We still think that they're able to get more contract, especially I think in Mexico, because I understand from them, Mexico need about 7 rigs every year to actually start for their exploring business. HarbourLink basically is another smaller cap proxy to transportation and logistics. Basically the same thing. I think it is to leverage on the export numbers, and I think for them the story is slightly different. They have one big development land in this Semaraju port. So Semaraju port is for those who actually follow the Sarawak score story, I think the ports have been doing very well. I think a lot of heavy industry, especially a power hungry industry, start to set up factory in those areas. That's why the ports are actually designed for such a potential export. So but the area now that they need more commercial and residential, we'll say the demand, and they are one of the bigger landowner there. So they will actually benefit from developing the land in Semaraju. So going forward, this company will have 2 income. One is definitely from their traditional, what do you call it, the transportation side, and the other interesting, I think the other income actually coming from their property. London Biscuit probably is worth to have a look. If you look at their PE, I think smaller cap normally they trade at a more attractive valuation compared to bigger cap. This is F&B stocks. they actually trade about less than 10 times PE. He actually off the radar of investors for some time because last time, I think for the last few years, they actually suffer from over expand and higher gearing. It took them 3 years to calm down their gearing, and only recently I think investors start to look at them again. Not only on the valuation but the improving balance sheet. Now I think the gearing at one point is about 2 times gearing. I think now it's about 0.6, 0.8 or 0.6. So it took them about 3 years to address that issue. The actually main product, if you know, I think is London biscuit, the Swiss roll. I think packet. So you should know. I think they're mainly for export also. Mitra Holding basically is a small cap construction player. They also, I think, enjoy quite a strong order book very recently. I think the order book at the historical high now about 1.5 billion in ringgit terms. We think that for this the 1.5 billion order book should last them easily for the next 2 years. Should actually keep them busy. So if you look at the PE, also less than 10 times. That indicate they should be able to get more project from the ETP related projects. Abini is our call for the only call for consumer retail. The call actually more on the valuation point of view because they used to trade at a high PE about 18 times. I think the correction actually came because what market worry is that with the GST, they might actually cut down in terms of consumer spending and therefore not benefiting the retail segment. And therefore, I think the share price has been correct for some time. I think so far they have been stabilizing around this price. But we think that the negative news could have been priced in already because for such from 17, 18 times PE, go all the way, I think, down to about 13 and 12 times PE, about so it's about 30%. So we think that probably is the time to look at them again. So this is basically what we actually have. We also have some others recommendation also. We have this product mainly for the retail. It's got on our radar. Some of this we are actually targeting for those stocks actually not really followed by the mainstream investor. Normally they are quite a smaller cap in nature. Like for instance, like public packaging. I think when we wrote about it, it's over about 7 times PE about, but the volume not really there. I've been performing after we actually recommended to our investor, like Cocoland. I think this is another one. I think very recently, that can attract some interest from the investor. We also have other recommendation. We have some retail product series. This is something like a portfolio for our retail investor. I think the performance has been very well. I think if I'm not mistaken, the quarter to date we registered about 4% kind of upside. I think CI only done about 2.0% only, so we are actually outperforming the CI. Yeah, so that is what we actually have for this session. So any questions are welcome from the floor. Thank you.